Before we begin, please note that this presentation is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent. The information provided here is not intended as financial, legal, or insurance advice. You should consult with a qualified professional before making any decisions regarding your auto insurance policy. Your individual circumstances are unique, and the strategies discussed may not be suitable for your specific situation. The average American driver overpays for their car insurance by over $700 every single year. Let that sink in. $700. That's a new phone, a weekend getaway, a significant chunk of your emergency fund. It's just gone, vanished into the coffers of a multi-billion-dollar industry that has become an expert at one thing, making the process so confusing, so frustrating, that you eventually just give up and pay the bill. You know the feeling. You get that renewal notice in your email. You brace yourself, you click it open, and you see the number. It went up. Again. But you haven't had an accident. You haven't gotten a ticket. You're driving the same car on the same road, so why are you being punished? It feels like you're trapped in a game where the rules are secret and you're destined to lose. Well, that game ends today. Right here, right now. Over the next several minutes, I am going to hand you the complete playbook for 2026. This isn't just a list of flimsy tips you've already heard. This is a deep dive into the system itself. We are going to dismantle the black box of insurance pricing, expose the algorithms, and reveal the psychological triggers they use against you. By the time this is over, you won't just save money, you will have total control over what you pay. You will know more than 99% of the population, and probably more than the junior agent on the other end of the phone. You will turn their complex game into your simple advantage. Forget the generic advice you've read on some random blog. Raise your deductible. Ask for discounts. That's first-grade stuff. It's like telling someone who wants to get in shape to eat less. It's not wrong, but it's useless without a real strategy. We're going past the basics and into the core of how your rate is actually calculated. We're going to build your defense, fortify your profile, and then execute a shopping strategy so effective, it will force companies to compete for your business, offering you their absolute lowest unadvertised rates. To do this, we need a framework, a battle plan. I call it the 3 pillars of auto insurance savings. Every single dollar you pay or save is determined by one of these 3 things. Pillar 1, your driver profile. This is how the insurance companies see you before you even ask for a quote. Pillar 2, your policy structure. This is how you build your coverage to get maximum protection for minimum cost. And Pillar 3, the shopping strategy. This is the proven method for making the market work for you, not against you. Today we start with the absolute foundation. Pillar 1, your driver profile. This is the most important pillar because it dictates your starting price. Everything else is built on this. If your profile is weak, you're stuck paying a premium for life. If your profile is strong, you get access to preferred rates the general public never even sees. Most people think their profile is just their driving record. That's not even half the story. Let's start with the single biggest factor that most drivers completely ignore. Your credit score. Yes, your credit score. In almost every state, your insurance company is judging you based on your financial history. They've run the numbers on millions of drivers and have found a direct correlation. People with lower credit scores tend to file more claims. It's a brutal statistical reality. They call it your insurance score, and it's basically a modified version of your credit report. They see it as a measure of your personal responsibility. Is it fair? It doesn't matter. It's how the game is played. The difference this one number makes is staggering. A driver with poor credit can pay on average double, that's 100% more, than an identical driver with excellent credit. Same car, same address, same driving record. The only difference is the credit score. We're talking about a potential $1,000 a year penalty for having a weak financial profile. So the first step in our 2026 insurance reset isn't to call your agent, it's to check your credit report, clean up any errors, pay your bills on time, lower your credit card balances. Every point you add to your credit score is like putting cash directly back into your pocket through lower premiums. Now, a quick note for those in California, Hawaii, and Massachusetts. Congratulations, your states have banned the use of credit scores in setting auto insurance rates. For the other 47 states, this is non-negotiable. It is the silent killer of your insurance budget. Next up in your profile is your driving history, but we need to look at it the way an underwriter does. They don't just see a ticket. They see a complex data point with a shelf life. Most people think a ticket from 2 years ago is the same as a ticket from 2 months ago. It's not. The impact of a violation decays over time. The most critical window is the last 12 months. Any incident here is a massive red flag. The next window is 13 to 36 months. Incidents here still hurt, but less so. After 36 months in most states, a minor violation like a speeding ticket has a dramatically reduced impact. After 5 years, it's often completely off their radar. What does this mean for you? It means timing is everything. If you have a ticket that's about to hit that 3-year anniversary, you must wait until after that date to shop for new insurance. Shopping 1 week too early could literally cost you hundreds of dollars because the algorithm will still be punishing you for it. Know your dates. Look at your motor vehicle report. Understand the timeline of your own history. Don't let an old mistake from 35 months ago haunt your premium for another year. Finally, let's talk about the most misunderstood factor of all, your location. Everyone knows your zip code matters, but they think it's just about crime rates. That's a tiny piece of the puzzle. When they look at your address, they are analyzing a massive data set. They know the frequency of accidents at the intersection down your street. They know the average cost of a bumper repair at the body shops in your town. They know the likelihood of hailstorms, flooding, and even the percentage of uninsured drivers in your specific area. They even know how litigious your local community is, meaning how likely people are to sue after an accident, driving up claim costs. You are being judged by the collective behavior of your neighbors. This is why you can move 2 miles to a different zip code and see your rates swing by 30 or 40%. While you can't always just move to save on insurance, understanding this is critical. It explains the why behind your rate. It shows you that it's not personal, it's purely statistical. It also means that when you are planning a move, the potential cost of car insurance should be a line item on your budget, right alongside rent or mortgage payments, because the financial impact can be just as significant. So we have the big 3 of your profile: your financial responsibility via your credit score, your recent driving history, and the risk profile of your physical location. Mastering these 3 elements is the first and most critical step to slashing your bill. It's about cleaning up your data and understanding the clock on past mistakes. But there is one hidden factor within your profile that is even more influential than your driving record for some people. It's a piece of data that insurers use to predict your future behavior, and almost nobody knows they have a say in how it's reported. Getting this one thing right can unlock a tier of pricing you never knew existed. This hidden report is officially called a CLUE report, which stands for Comprehensive Loss Underwriting Exchange. But I like to call it your insurance ghost. Follows you everywhere, it affects your financial life in a huge way. And for most people, it's completely invisible. Let me tell you about a woman we'll call Jessica. Jessica is what you'd call a perfect driver. 15 years on the road, not a single at-fault accident. Never even gotten a speeding ticket. Yet, every 6 months she'd watch her auto insurance premium creep up. 5% here, 8% there. She called her agent, who gave her the usual runaround about inflation, rising repair costs, more accidents in her zip code. It all sounded plausible, but it felt wrong. She was being punished, but she didn't know what her crime was. Jessica's story isn't unique. Millions of Americans are in the same boat, paying a secret penalty on a record they've never even seen. They believe their driving record is just what the DMV has on file. And that's the first and most expensive mistake. You don't have one driving record. You have 2. The first is your motor vehicle report, or MVR. This is the one you know about. It's the official record kept by your state's Department of Motor Vehicles. It lists your traffic violations, license suspensions, and any officially reported accidents. Insurers pull this report to see if you're a safe, law-abiding driver. Now, you'd think this report would be accurate. It's a government document, after all. But you would be shocked at the number of errors that litter these files. Clerical errors, tickets that were dismissed in court but never removed from the record, accidents where you were found not at fault, but are still listed in a way that makes you look guilty. One of the most common and costly errors is a simple case of mistaken identity. Another driver with a similar name and date of birth has their horrible driving record merged with yours. You're paying for some stranger's lead foot. So, your first mission right now is to get a copy of your MVR. You can typically order it directly from your state's DMV website for a small fee, usually between $5 and $25. It is the single best investment you will ever make in your insurance life. When you get it, comb through it line by line. Don't just skim it. Is that really your ticket? Did that accident happen that way? Was that citation actually dismissed? If you find an error, you have the right to challenge it. You'll need to contact the DMV and the court system that handled the original ticket. It takes some paperwork, some phone calls, but removing a single incorrect violation can drop your premium by hundreds of dollars a year, instantly. This is the basic cleanup. But this isn't the ghost. The MVR is the history you know about. The real damage is being done by the history you don't. That brings us back to that CLUE report. This isn't a government document. It's a massive database run by a private data broker called LexisNexis. Think of it like a credit report but for your insurance history. For up to the last 7 years, it tracks every single auto insurance claim you've ever filed, no matter how small. It shows the date of the incident, the type of loss, how much the insurance company paid out, and which car was involved. And nearly every single insurance company in the United States, we're talking over 99% of them, uses this report to decide how much to charge you. If they see you filed a few claims in the past, even if none of them were your fault, they'll classify you as a higher risk. To them, you're not unlucky. You're a magnet for trouble. A history of claims on your CLUE report can easily double or even triple your premium. It can even get you denied coverage altogether. But here is the most insidious part. The part that should make you furious. The CLUE report doesn't just track claims you've made. It can also track inquiries you've made about a potential claim. Let me paint a picture for you. You're driving home, and a rock flies up from a truck and puts a big crack in your windshield. You get home and you do what any normal person would do. You call your insurance agent and say, "Hey, my windshield is cracked. My deductible is $500. I think a new windshield is about $600. Is it even worth filing a claim for this?" Your agent says, "No, for $100 it's not worth it. It'll count as a claim and could raise your rates." You say, "Okay, thanks for the advice." And you hang up. You pay the $600 out of your own pocket and get the windshield replaced. You never filed a claim. You never received a single dollar from the insurance company. In your mind, the transaction is over. But it's not. That phone call, that simple inquiry, can be logged by the insurance company and reported to the CLUE database. It can be listed as a loss of no pay or a damage inquiry. And for the next 7 years, every time you apply for new insurance, the underwriters at other companies will see that inquiry. They don't know the context. They don't know you paid for it yourself. All they see is an incident, a data point. And that data point tells them that on that date, your car sustained damage. It makes you look riskier. You get penalized for simply asking a question. You are punished for being a responsible consumer trying to understand your own policy. This is the ghost in the machine. It's the reason why Jessica, our perfect driver, was seeing her rates go up. 3 years earlier, someone had backed into her car in a parking lot, leaving a tiny dent in her bumper. She called her agent to ask if her policy covered it. When she found out the other driver's insurance would handle it, she never spoke to her own company about it again. But the inquiry was logged. It sat there on her invisible record, a tiny red flag that cost her hundreds of dollars over the years. So what do? You fight back with knowledge. Under the Fair Credit Reporting Act, you are legally entitled to a free copy of your own CLUE report every 12 months. The website is lexisnexis.com/personal reports. Do not go anywhere else. You'll have to provide some personal information to verify your identity, but it's a secure process. Within a few days, you will receive a document that details your entire claims history for the last 7 years. This is your moment of truth. Go through it with a fine-tooth comb. Look for claims you don't recognize. Look for inquiries that shouldn't be there. Look for accidents where the fault is described inaccurately or the payout amount is wrong. If you find an error, and many people do, you have the right to dispute it. You can file a dispute directly with LexisNexis. They are legally obligated to investigate your claim within 30 days. You can also file a statement of 100 words or less to be added to your report, explaining your side of the story for any entry you believe is misleading. Getting an unfair inquiry or an incorrect claim removed from your CLUE report is like having a bankruptcy wiped from your credit history. It fundamentally changes how companies see you. It unlocks a new lower tier of pricing that you were previously blocked from, all because of data you didn't even know existed. Cleaning up your MVR and your CLUE report is the most powerful thing you can do to fix the financial penalties of your past. It's about ensuring the story being told about you is the truth. But once you've scrubbed your history clean, the game changes. The battleground shifts from the past to the present. Because right now, as you drive, your car is creating a brand new record of your behavior in real time. Insurers are no longer content to just look at your past. They want to watch your future unfold. They want to know how fast you accelerate, how hard you brake, what time of day you drive, and even where you go. The technology that enables this is probably already in your car or on your phone, and it's called telematics. And the story they tell you about how it saves you money is only half the truth. In the next part, we're going to expose how this real-time tracking is being used against you, and how you can turn the tables on the spy in your dashboard. So let's talk about the spy. It goes by many names: Snapshot, DriveWise, Drive Safe, and Save. But at its core, it's a small device you plug into your car's OBD2 port, or an app on your phone that promises a simple deal. Let us watch you drive, and if you're a good driver, we'll give you a discount. Sounds fair. It sounds modern. But this deal is a Trojan horse. Because the algorithm judging you isn't a fair and impartial observer. It's a cold, calculating system with one fatal flaw. It has zero understanding of context. Imagine this. You're driving down a residential street. A kid darts out from between two parked cars to chase a ball. You slam on the brakes, your anti-lock system engages, and you stop just inches away. You're a hero. You just saved a life. But the little spy in your dashboard doesn't see a hero. It sees an event logged as hard-braking incident. It sees a data point that labels you as an aggressive, high-risk driver. It doesn't know about the kid. It doesn't know about the ball. It just knows the G-force of your stop exceeded a certain threshold. And just like that, a point is scored against you. A few of those incidents, and that discount you were promised? It evaporates. Worse, your base rate at your next renewal could actually go up. You are penalized for being a safe, defensive driver. It gets more insidious. Let's talk about when you drive. Are you a nurse coming home from a late shift? A restaurant worker closing up for the night? A student pulling an all-nighter at the library? The telematics device tracks the time of day you're on the road. And statistically, driving between midnight and 4 a.m. is riskier. There are more drunk drivers, more fatigue-related accidents. So the algorithm flags you. It doesn't see a responsible person earning a living or getting an education. Sees a liability. Punishes you for your work schedule, for your ambition. The system designed to reward safe driving is now penalizing you for your lifestyle. And then there's where you drive. The GPS in these systems is precise. It knows every street you turn down, every highway you travel. Insurance companies buy massive amounts of data about accident frequency, theft rates, and vandalism for every zip code, every neighborhood, every single street. If your daily commute takes you through an area they've statistically labeled as high risk, even if you're just on the freeway passing through, the algorithm docks you. You could be the safest driver in the world, but because your route takes you through the wrong part of town, you're judged guilty by association. Your premium is calculated not just on how you drive, but on where you exist in the world. But here is the single most shocking part of this entire scheme. This is the part they will never ever tell you about in the commercials. Your driving data, all those hard brakes, late-night trips, and routes through bad neighborhoods, isn't just being used by your insurance company. It's being collected, packaged, and sold. Companies like Progressive and Allstate don't just keep this data for themselves. They feed it into massive data exchanges, the largest of which is run by a data broker you've probably heard of, LexisNexis. It's called the LexisNexis Telematics Exchange. Think of it like a credit bureau but for your driving habits. Your insurer sends your daily driving score to this exchange. Now let's say after a year with Progressive, you decide to shop around for a better rate. You go get a quote from Geico. What's the first thing Geico does? They don't just check your credit score and your official motor vehicle report. They ping the telematics exchange. And they pull up the entire history of driving data that Progressive collected on you. Every mistake, every hard brake, every late-night drive you've ever made while being monitored is now in their hands. It's a permanent record, a secret driver score, that follows you from company to company. You thought you were just sharing data with one company for a discount. In reality, you were creating a permanent file on yourself that the entire industry can use to justify charging you higher rates for the rest of your life. The spy you voluntarily put in your car isn't just working for its owner. It's working for every insurance company. It's an industry-wide surveillance network, and you paid for the privilege of being its main target. The data you gave them to get a discount has been weaponized against you to ensure you can never escape your past. This is the point where most people feel helpless. They feel trapped. The system seems rigged, the game unwinnable. But what these companies don't want you to know is that this system, like any system, can be gamed. The spy in your dashboard has a blind spot, and we are going to exploit it. Here's how you turn the tables. Most telematics programs have what's called an initial monitoring period. It's usually the first 90 days or sometimes up to 6 months. This is the critical window. This is the period where the algorithm is building its baseline profile of you. The score you get in this initial period has a massively oversized impact on the discount you receive. For many policies, this initial score is what locks in your discount for the entire term, or even for as long as you stay with the company. The ongoing monitoring after that period often matters far less. So, for those first 90 days, you treat it like you're taking your driver's test all over again. You become the most boring, predictable, perfect driver on the planet. You are not yourself. You are playing a character. The character of perfectly insurable client. This means no rapid acceleration. Pretend there's a raw egg under your gas pedal. Squeeze it gently. Pull away from stoplights like you're driving a limousine with a VIP in the back. Brake early. Incredibly early. Leave 3, 4, 5 car lengths in front of you. Coast to a stop. The algorithm can't tell the difference between a skilled driver braking appropriately and someone braking unnecessarily early. It just sees a gentle low G-force stop. For these 90 days, you become a morning person. You avoid driving late at night at all costs. If you need to go to the store at 10 p.m., you go at 7 p.m. instead. Or you go the next morning. If your job requires late-night driving, this strategy is tougher, but try to minimize any other late-night trips. And be mindful of your routes. If you have 2 ways to get home and one goes through a slightly better rated area, take that route, even if it's a few minutes longer. You are manufacturing a perfect data set. You are feeding the spy exactly what it wants to see. Once that initial 90-day or 6-month period is over and you get that email confirming your 25, 30, or even 40% discount is locked in, you've won the first battle. Now you check the policy rules. For many plug-in devices, they actually ask you to mail it back. They have what they need. For app-based programs, you can often turn off the location permissions. The key is you ace the final exam and now you can relax. You got the maximum discount by giving them a short, perfect, and completely artificial snapshot of your driving. And here's the expert-level move. Before you even sign up, you ask the agent 2 very specific questions. 1. Is my discount determined by an initial period or by continuous monitoring? And 2. Do you share my personal driving data with any third-party data exchanges, like the LexisNexis Telematics Exchange? Their answer and how they answer will tell you everything you need to know about the game you're about to play. Finally, remember that under the Fair Credit Reporting Act, you have the right to see the data that companies like LexisNexis are keeping on you. You can go to their website and request your free consumer disclosure report. In it, you may find your secret driver score. You can see the data they've collected and you can dispute any inaccuracies. This is your data. You have a right to see it and to control it. You can turn the tables on the spy because now you know how it truly works. You've just learned how to outsmart the algorithm in your car. But the surveillance doesn't stop there. Insurers are now building a psychological profile on you, based on your online shopping, your magazine subscriptions, even the car you choose to buy. In the next part, we'll uncover the hidden credit and social scoring systems that are jacking up your rates before you ever even turn the key. It's not your FICO score. It's not your driving record. It's a secret number, a ghost in the machine, and it has more power over your wallet than you can possibly imagine. This is your insurance score, sometimes called an auto insurance score or a credit-based insurance score. And it is the single most important and most misunderstood factor in determining your car insurance premium. Over 95% of auto insurers in the United States use this score to decide if you're a good risk or a bad one. But here's the critical twist, the part they don't advertise. This score isn't designed to predict if you can pay your bill on time. It's designed to predict the future. Specifically, it's a complex algorithm that predicts your likelihood of filing a claim. Think about that. Before you've even had a fender bender, before you've even been pulled over, a statistical model has already decided how likely you are to cost the insurance company money. And it's doing this largely by looking at your financial habits. The logic, backed by mountains of industry data, is that how you manage your money is a powerful indicator of how you manage your life, including how you behave behind the wheel. It's a correlation, not a causation. A low credit score doesn't cause you to be a bad driver. But for decades, insurers have found that, on average, people with lower credit scores file more claims. More frequent claims, more severe claims, and even more fraudulent claims. So, they built an entire pricing system around it. So what exactly is in this secret sauce? While every company has its own proprietary formula, they all pull from the same 5 main ingredients of your credit history. First and most important is your payment history. This is the bedrock of your financial reputation. Do you pay your bills on time every time? A history of late payments on credit cards, mortgages, or car loans sends up a massive red flag. To an insurer, it doesn't just say you're forgetful. It suggests a pattern of instability or a lack of attention to detail, traits they believe correlate with risky driving. Second is the amount of debt you carry, often called your credit utilization ratio. This is the percentage of your available credit that you're currently using. If you have a $10,000 credit limit across all your cards and you have a $9,000 balance, your utilization is 90%. That's extremely high. To an insurer, maxed out credit cards signal financial distress. The thinking is that someone under immense financial pressure might be more distracted, more stressed, and might even be tempted to delay essential car maintenance like replacing worn-out tires or fixing bad brakes, all of which increases the likelihood of an accident. Third is the length of your credit history. How long have you been managing credit? A longer history provides a clearer picture of your long-term financial behavior. Someone who has successfully managed credit accounts for 20 years is seen as more stable and predictable than someone who just got their first credit card 6 months ago. It's about establishing a track record of responsibility. Fourth, they look at your pursuit of new credit. How many new accounts have you applied for recently? If you've applied for 5 different credit cards and 2 personal loans in the last year, it can look like you're desperate for cash. This is another indicator of potential financial instability, which, again, they correlate with higher risk on the road. And finally, they consider your credit mix. Do you have a healthy combination of different types of credit, like a mortgage, an auto loan, and a couple of credit cards? Or is your entire credit profile just a single, high-interest department store card? A diverse mix of credit, managed responsibly, suggests financial sophistication and stability, which insurers reward with lower premiums. But it doesn't stop with your credit report. This is where the social scoring we hinted at comes into play, and it gets even more controversial. Insurers buy vast amounts of data from third-party data brokers to build an even more detailed picture of you. They look at factors that have absolutely nothing to do with your driving or your finances, but have statistical correlations with claims. Things like your level of education. Actuarial tables have shown that individuals with a bachelor's degree or higher tend to file fewer claims than those with only a high school diploma. Is it fair? Absolutely not. But it's statistically true, so it often gets factored into the algorithm. Your occupation matters too. And I'm not just talking about the obvious, like a pizza delivery driver versus a librarian. They look at job stability. Have you been at the same company for 10 years? That signals stability. Bouncing between jobs every 6 months? That signals risk. Even your marital status plays a role. Married individuals are statistically less likely to be in an accident. They're viewed as more settled, more responsible. And homeownership. Owning a home is seen as a major anchor of stability in your life, another plus in their scoring model. Renting is viewed as more transient and therefore slightly riskier. Put it all together and you can see how the system can feel rigged. You could be the safest driver in the world with a spotless record, but if you're a single renter with a recent job change and a high credit card balance because of a medical emergency, the algorithm can brand you a high-risk driver and charge you a fortune. This is why the practice is so controversial that several states, including California, Hawaii, and Massachusetts, have banned or severely restricted the use of credit information in setting auto insurance rates. For the rest of us, though, this is the game we have to play. So, how do you fight back? How do you master this hidden system and turn it to your advantage? It starts with knowing where you stand. You can't see your specific insurance score, but you can see its primary ingredient, your credit report. By law, you are entitled to a free copy of your credit report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, every single year. Go to the official government-mandated site, annualcreditreport.com. Don't get tricked by imposter sites. Get your reports and treat them like a diagnostic test for your insurance rates. First, check for errors. A study by the Federal Trade Commission found that 1 in 5 consumers had an error on at least one of their credit reports. 1 in 5. A single mistake, a late payment that wasn't late, an account that isn't yours, could be costing you hundreds of dollars a year in higher premiums. If you find an error, dispute it immediately with the credit bureau. They are legally required to investigate. Next, start practicing what I call Rate-conscious credit hygiene. The single biggest impact comes from paying every single bill on time. No exceptions. Set up automatic payments for everything you can. Even one 30-day late payment can tank your score and spike your premium. Then, attack your credit utilization. Focus on paying down the balances on your credit cards, especially those closest to their limits. The goal is to get your overall utilization below 30%, and ideally below 10% to see the best results. A powerful but counterintuitive tip: don't close your old, unused credit card accounts. A huge part of your score is the length of your credit history and your total available credit. Closing an old card shortens your history and reduces your available credit, which instantly increases your utilization ratio. Both of those things will hurt your score. Just cut up the card if you don't trust yourself, but keep the account open. Finally, here is the ultimate insider trick: the positive life event re-rate. Insurance companies will automatically reevaluate you if your score goes down, but they rarely do it if your score goes up. You have to be proactive. Have you significantly improved your credit score in the last year? Did you just get married, buy a house, or land a big promotion? These are all signals of reduced risk in their eyes. Don't wait for your renewal. Call your insurance agent today. Tell them about your positive life change and specifically ask them to rerun your insurance score or re-rate your policy. A 5-minute phone call could literally save you hundreds, even thousands of dollars over the life of your policy. They won't offer it. You have to ask for it. By understanding this hidden scoring system, you're no longer a victim of it. You can take control, clean up your financial profile, and directly influence the price you pay. You are turning their secret weapon into your personal savings tool. So you've cleaned up your credit. You've called your insurer. You've proven on paper that you're a responsible adult. But what if they still don't believe you? What if they want to watch every single move you make? In the next part, we're going to plug into the world of telematics, and I'll show you how the little black box in your car could be your greatest savings tool or your worst financial nightmare. So, how does a simple piece of technology become your worst financial nightmare? Starts with a single bad day. Imagine you're running late for the most important meeting of your life. You accelerate a little faster than usual. You take a corner a bit too sharply. Then a kid on a bike darts out from behind a parked car, and you slam on the brakes, your heart pounding in your chest. You avoided an accident. You're a hero, right? Not to the little black box plugged into your car. To the algorithm, you're not a hero. You're a liability. You're a collection of red flags. Rapid acceleration, hard cornering, and a severe braking event. All logged, all time-stamped, all sent directly to your insurance company. And at your next renewal, you open the bill to find your good driver discount has vanished. In its place is a 20, maybe 30% surcharge. All because you were a safe, defensive driver in a critical moment. This is the dark side of telematics. It's the promise of a discount dangled in front of you, in exchange for total, unfiltered, and often misunderstood surveillance. They track the time of day you drive. Are you a night owl? That's a risk. Your premium goes up. Do you live in a city and have to brake frequently because of, traffic? That's a risk. Premium goes up. The system has no context. It doesn't know you braked hard to avoid a deer. It doesn't know you sped up to safely merge onto a highway. Just knows data points. And those data points can be used to paint a picture of you as a reckless driver, even when you're not. It's a system where you are guilty until proven innocent, and the trial happens every single second you're behind the wheel. The worst part? Once you agree to it, opting out can be seen as an admission of guilt. Some policies are even written so that if you unplug the device, it can be grounds for dropping your coverage entirely. You're trapped. But what if I told you that you could flip the script? What if you could use their own system against them to lock in the biggest discounts they offer? What if you could turn that little spy into your personal ATM? This is where we stop being afraid of the technology and start making it work for us. Because for every horror story, there's a driver out there saving $500, $1,000, even $1,500 a year. And the difference between them and everyone else is that they understand the game. And today, I'm going to teach you the rules. First, let's break down exactly what these devices are watching. There are typically 6 key metrics. Master these and you've mastered the game. Number 1, braking. This is the big one. Hard braking events are the number 1 penalty. So what is a hard brake? In most systems, it's defined as slowing down more than 7 miles per hour in a single second. Sounds like a lot, but it's easier to trigger than you think. The secret to avoiding it is simple, and it's something you should be doing anyway. Increase your following distance. Don't tailgate. Look further down the road. See the stale green light up ahead? Don't race to it. Start coasting. Anticipate the flow of traffic. By simply leaving one extra car length in front of you, you can eliminate 90% of hard braking events. Number 2. Acceleration. This is the opposite of hard braking. Most telematics apps flag you for increasing your speed by more than 7 or 8 miles per hour in 1 second. Think of it as the jackrabbit start penalty. The fix? Pretend there's an open cup of coffee in your cup holder, and you don't want to spill it. Apply gentle, even pressure to the accelerator. Not only will your insurance score thank you, but your gas mileage will skyrocket. It's a 2-for-1 win. Number 3. Time of day. This is the silent killer of discounts. Insurers have mountains of data, and that data says that driving between midnight and 4 a.m. is dramatically more dangerous. Accidents are more likely to be fatal due to drunk drivers, fatigue, and lower visibility. So, if your job requires you to be on the road late at night, a telematics program might actually hurt you more than it helps. But for most of us, simply being aware of this can be a game changer. If you need to make a late-night run to the store, ask yourself if it can wait until morning. During your initial tracking period, which we'll talk about in a minute, avoiding these hours is absolutely critical. Number 4. Mileage. This is straightforward. The less you drive, the less risk you represent. This is why telematics is a godsend for remote workers, retirees, and students who live on campus. If you're driving less than 10,000 miles a year, you should be shouting from the rooftops for one of these programs. There are even specific pay-per-mile policies that can offer insane savings. But be honest with yourself. If you have a long commute, the mileage penalty might cancel out any gains you make from your good driving habits. Number 5. Cornering. This is a subtle one most people don't think about. A hard cornering event is triggered when your car experiences a high G-force while turning. Basically, it's a sign you're taking turns too fast. The solution is obvious. Slow down before you enter a turn, not while you're in it. Brake in a straight line, then coast through the apex of the turn, and accelerate out gently. It's the same technique race car drivers use to be smooth and fast, and it's the same technique you can use to max out your insurance discount. And finally, the metric that terrifies everyone. Number 6. Phone usage. Yes, they can see you. If you're using a smartphone app for your telematics, it has access to your phone's internal sensors, like the accelerometer and gyroscope. It knows when you pick up the phone, when you're tapping the screen, and when you're holding it to your ear for a handheld call, all while the car is in motion. This is the single easiest way to fail your driving assessment. The policy is zero tolerance. Do not touch your phone while driving. Use a hands-free mount. Set your GPS before you leave. Put your phone on Do Not Disturb mode. If you absolutely have to use it, pull over safely. There is no discount worth the risk, and with telematics, you are guaranteed to get caught. Okay, so you know the 6 metrics. You know what they're watching. Now, how do you turn this knowledge into cold, hard cash? This is the strategy the pros use. It's called the golden window. Almost every telematics program has an initial evaluation period. It's usually the first 30 to 90 days after you sign up. During this golden window, the algorithm is learning your habits and building your baseline profile. Your performance during this window is disproportionately important. It sets the discount that will likely apply for the entire first term of your policy, and often, it's the anchor for future renewals. So, for those first 30 days, you drive like you're chauffeuring the president. You are the perfect driver. You leave for second following distances. You accelerate like a sloth. You take corners at a crawl. You don't even think about driving after 10 p.m. And you absolutely, under no circumstances, touch your phone. You treat it like a video game where the high score saves you $1,000. Because it does. By acing the golden window, you lock in the maximum possible discount. And here's the secret. For most companies, that discount becomes sticky. While your score will still fluctuate a little bit based on your ongoing habits, it's much harder for it to drop dramatically after you've established that stellar baseline. You've set the bar high, and the algorithm will be more forgiving of a rare hard break or a late-night drive down the line. You played their game and you won. Now a crucial choice. Do you use the plug-in device that goes into your car's OBD2 port? Or do you use the smartphone app? The plug-in device only gets data from the car itself, speed, braking, mileage. The smartphone app gets all of that, plus data from your phone like phone usage and potentially even your location data outside the car. The plug-in device is less invasive. However, the apps are often more convenient and sometimes offer a higher initial discount to encourage adoption. My advice? If you're disciplined about not using your phone, the app can be fine. If you have even the slightest temptation, or you're concerned about privacy, stick with the physical plug-in device. Telematics isn't a monster hiding under your dashboard. It's a tool. And like any tool, it can be used for you or against you. By understanding exactly what it measures and by strategically acing that initial golden window, you take control. You stop being a passive subject of surveillance and become an active participant in lowering your own bills. You turn their data points into your dollars. You've now mastered the technology inside your car to get the best rate. But what if the biggest factor affecting your premium has absolutely nothing to do with your car, your driving, or any device at all? What if it's a 3-digit number that you probably check for your mortgage or your credit cards, but never dreamed would be the secret key to unlocking massive auto insurance savings? In the next part, we expose the shocking and controversial link between your credit score and what you pay for insurance. And I'll show you how improving one can save you thousands on the other. It's the one factor that makes people's blood boil. The idea that your financial history, something that feels completely unrelated to your driving habits, could be one of the single biggest levers determining your auto insurance premium. Feels unfair, feels invasive, and in some states it's actually illegal. But for the vast majority of Americans, your credit score is a silent, invisible passenger in your car, and it's telling your insurance company a story about you. And that story could be costing you thousands of dollars every single year. So what is the connection? Why would an insurance company care if you were late on a credit card payment 3 years ago? It all comes down to a controversial little number called a credit-based insurance score. This is not your FICO score, but it's built from the same raw materials found in your credit report. For decades, insurance companies have been crunching data on millions and millions of customers. And what they found was a powerful, and to them, undeniable correlation. People with higher credit scores on average file fewer claims. Now let's be crystal clear. Correlation is not causation. A high credit score doesn't magically make you a better driver. You don't suddenly develop Jedi-like reflexes because you paid your mortgage on time. The insurance industry's argument is that this score is a proxy for responsibility. Their data suggests that a person who is meticulous about managing their finances is also more likely to be meticulous in other areas of their life, like maintaining their vehicle's brakes, getting their oil changed on time, and generally avoiding risky behaviors. They see financial responsibility as a reflection of overall personal responsibility. But is that fair? Many people, and even several state governments, say absolutely not. California, Hawaii, and Massachusetts have banned or severely limited the use of credit in setting auto insurance rates. Why? Because life happens. A sudden job loss, a medical emergency that insurance didn't cover, a messy divorce. These events can absolutely tank a person's credit score, often through no fault of their own. Does a cancer diagnosis suddenly make you more likely to run a red light? Of course not. But in most states, the financial fallout from that diagnosis could cause your insurance premium to skyrocket. This is the heart of the controversy. It's a system that can penalize people for simply being unlucky. But for now, in most of the country, this is the reality we have to work with. And understanding the financial stakes is the first step to fighting back. The impact of your credit score on your insurance premium is not a minor detail. It is a seismic shift. Let's look at some representative numbers for a standard policy. A driver with an excellent credit score, say 780 or above, might be paying around $1,500 a year for their policy. Now let's take that exact same driver, same car, same driving record, same address, and only change one thing, their credit score. If their score is just in the good range, around 720, their premium could jump to $1,800. That's a $300 penalty. But it gets much, much worse. If that score drops into the fair category, somewhere in the high 600s, the premium could easily balloon to $2,500. That's $1,000 more per year than the driver with excellent credit. And if the score falls into the poor category, below 650, it's not uncommon to see that premium double or even triple, soaring to $4,000 or more. That is a $2,500 difference every single year. Think about that. That's a mortgage payment. That's a family vacation. That's a new computer. It's a massive wealth transfer from your pocket to the insurance companies, based on a number that has nothing to do with whether you use your turn signal. This is why understanding and improving your credit isn't just a good financial habit. It's one of the most powerful insurance saving strategies you have. So how do we do it? How do we turn this unfair system to our advantage? Simpler than you think. You don't need to be a financial wizard. You just need a game plan. First, you need to know your enemy. Go to annualcreditreport.com. This is the official government-mandated site where you can get your full credit reports from all three major bureaus, Equifax, Experian, and TransUnion, for free. Your job is to become an auditor. Scour those reports for errors. A paid-off loan that's still showing a balance? A late payment you know you made on time? A collection account you've never heard of? These errors are surprisingly common, and they can be anchors dragging your score down. Dispute every single inaccuracy you find. This is the lowest hanging fruit and can give you an immediate boost. Second, understand what matters most. Your payment history is the king of your credit score, making up about 35% of it. One single late payment can stay on your report for 7 years and can drop your score by dozens of points overnight. The solution here is to create a safety net. Log into every single one of your credit card and loan accounts online and set up autopay for the minimum payment. Not the full balance, just the minimum. This ensures that no matter how busy or forgetful you get, you will never ever be marked as late. You can always go in and pay more manually before the due date, but this simple action makes a catastrophic late payment virtually impossible. Third, tackle your credit utilization. This is the queen of your score, making up another 30%. It's simply the amount of debt you're carrying compared to your total credit limit. The rule of thumb is to keep your utilization below 30% on each card and overall. If you have a credit card with a $10,000 limit, you never want the balance to be more than $3,000. But for a pro-level boost, aim for under 10%. Insurance companies see high utilization as a sign of financial distress. Here's a powerful hack that doesn't involve paying off debt. If you have a good payment history with the credit card company, call them and ask for a credit limit increase. If they raise your $10,000 limit to $20,000, your $3,000 balance instantly goes from 30% utilization down to just 15%. You haven't spent or paid a dime, but you've just improved a massive component of your score. Fourth, play the long game. The length of your credit history accounts for about 15% of your score. This means that old credit card you got in college, even if you never use it, is incredibly valuable. It's like a wise old grandparent on your report, adding age and stability. Do not close these old accounts. To keep them active so the bank doesn't close them, just put one small, recurring charge on them like a streaming service or a coffee subscription, and set that to autopay. This keeps the account alive and working for you in the background. Finally, the last 20% is a mix of new credit and your credit mix. The takeaway here is simple. Avoid applying for a bunch of new credit cards or loans in the 6 months before you shop for car insurance. Each application can cause a small temporary dip in your score, and a flurry of them makes you look risky. Here is the most important part of this entire strategy. You don't have to wait years for your score to go from 650 to a perfect 850. The biggest savings come from making categorical jumps. Moving from poor to fair credit, or from fair to good, can unlock huge discounts. Once you've spent a few months cleaning up your report, paying on time, and lowering your utilization, and you see your score tick up by 20, 30, or 40 points, that is your signal. That is the moment to reshop your auto insurance. Your current rate is locked in based on your old, lower score. By getting new quotes, you are forcing them to reevaluate you based on the new, more responsible financial profile you've built. You are showing them the new you, and demanding the better rate you now deserve. We've just spent all this time optimizing a number on a screen. But what about the single biggest, most obvious factor in your insurance rate? The hunk of metal sitting in your driveway. In the next part, we're going to reveal the shocking insurance death list of 2026, the cars that insurers secretly hate, and the surprising budget-friendly models that can cut your premium in half just by being what they are. Alright, let's pull back the curtain on the industry's best-kept secret. Every single day, insurance underwriters look at a list of vehicles, and they either smile or they shudder. This isn't about which car looks best or drives fastest. It's a cold, hard calculation of risk. And for you, knowing which cars are on their most wanted list versus their most hated list is the difference between a manageable monthly payment and a financial nightmare. First, let's talk about the cars that are absolute premium predators, the ones that insurers red flag immediately. Topping this list, and this will surprise no one, are the high-performance muscle cars and exotic sports cars. Think Dodge Charger Hellcat, Ford Mustang GT500, or any Porsche with more than 2 doors. It's not just about the raw speed, although that's a huge factor. Insurers see these cars and their algorithm flashes 3 giant warning signs. high accident frequency, extreme repair costs, and astronomical theft rates. The driver profile for a 700 horsepower street-legal rocket tends to be, shall we say, more spirited than the person driving a minivan. This leads to more claims. When a claim does happen, you're not just replacing a bumper. You're replacing a custom-molded carbon fiber aerodynamic component that costs more than a used Toyota. And theft? High-powered Mopar vehicles have become such a target for sophisticated thieves that in some major cities, getting a reasonable insurance quote for one is nearly impossible. They are, from an insurer's perspective, a catastrophic loss just waiting to happen. Next on the hit list are the high-end luxury imports, specifically from Germany. Your new BMW, your top-of-the-line Mercedes-Benz, your fully loaded Audi. You might be the safest driver in the world, but your insurance company isn't just insuring you. They're insuring the mind-boggling complexity and cost of the vehicle itself. Let me put it this way. A minor fender bender in a 10-year-old Ford Focus might be a $1,500 repair. That same fender bender in a new Mercedes S-Class could be a $20,000 catastrophe. Why? Because the bumper is no longer just a piece of plastic. It's a housing for a dozen sensors, parking sensors, adaptive cruise control radar, blind spot monitors. The grille has cameras. The windshield has rain sensors, light sensors, and calibration tech for the lane keep assist that requires a specialist and a 4-hour computer recalibration if it's replaced. Even a headlight isn't a bulb anymore. It's a sealed, adaptive laser matrix computer module that can cost $4,000. To an insurer, every one of these cars is a delicate, rolling supercomputer, and they are pricing your policy to account for the inevitable and wildly expensive cost of repair. Now for the one that shocks people, certain electric vehicles. We've been told EVs are the future, clean, quiet, and efficient. But insurers are looking at a different set of data, and it's making them nervous. The issue isn't the small, affordable EVs. It's the high-performance, long-range, luxury models. The number one problem is the battery. The battery pack in a high-end EV can account for 40 to 50% of the entire vehicle's cost. If it's damaged in an accident, even an accident that seems minor, it often cannot be repaired. It has to be replaced entirely. We're talking about a single part that can cost $20, $30, even $40,000. This reality has led to a bizarre situation where EVs with minor collision damage are being declared a total loss by insurers because the cost of the battery replacement is more than the car's current value. It's a massive financial risk for them, and they are passing that risk directly onto you in the form of higher premiums. Add in the need for specialized certified technicians and the same complex sensor technology we saw in the German luxury cars, and you have a recipe for a surprisingly expensive insurance bill. Finally, on the death list are the most frequently stolen vehicles in America. This has less to do with how the car drives and everything to do with how easy it is to steal. For years, full-size pickup trucks like the Ford F-Series and Chevy Silverado have topped this list. They are everywhere, their parts are in high demand, and they can be stripped down or resold quickly. But a more recent and frankly scandalous addition to this list are certain models of Kias and Hyundais manufactured over the last decade. Due to a lack of a simple, inexpensive anti-theft device called an engine immobilizer, these cars became the target of viral social media trends, leading to an explosion in thefts nationwide. The problem became so severe that some major insurance companies flat out refused to write new policies for these specific models in certain zip codes. If the company that's in the business of managing risk decides your car is too risky for them to even touch, that tells you everything you need to know. So that's the dark side. The cars that make underwriters lose sleep at night. But what about the other side of the ledger? What are the unsung heroes? The cars that insurers secretly love to see? This is the golden list. And driving one of these can feel like getting a secret, built-in discount. Topping the golden list is the category I call boring is beautiful. These are your sensible family sedans and compacts. The Toyota Corolla, the Honda Civic. Not the sporty C or Type R models, but the basic, reliable commuters, the Subaru Impreza. Why are these so cheap to insure? It's a perfect storm of positive factors. First, their safety ratings are consistently excellent. They are designed to protect occupants, which means fewer and less severe injury claims, which are the most expensive claims of all. Second, they are ubiquitous. There are millions of them on the road, which means parts are plentiful and cheap. A damaged door for a Honda Accord can be found at any salvage yard in the country. A damaged door for a Maserati? Not so much. Third, and this is key, is the driver profile. The data shows overwhelmingly that the people who buy these cars are not aggressive risk takers. They are commuters, small families, and practical-minded individuals. They drive defensively, they follow the rules, and they file fewer claims. For an insurer, boring means predictable, and predictable means profitable. Next up on the golden list, the family haulers. Minivans and midsize SUVs. Think the Honda Odyssey, the Toyota Sienna, the Subaru Forester, or the Toyota RAV4. The soccer mom stereotype is a powerful force in the world of insurance data. When an underwriter sees a minivan on a policy, they see a driver who likely has children in the car. This is statistically one of the most powerful indicators of safe driving behavior. People simply drive more cautiously when they have kids in the back. These vehicles are also, by their very nature, the opposite of high performance. They are built for safety and utility, not speed and cornering. They are packed from floor to ceiling with safety features, from side curtain airbags to automatic emergency braking. They are rarely stolen. They are, in short, an insurer's dream vehicle. And what about the electric vehicles that don't cost a fortune to insure? They absolutely exist. The key is to look at the less glamorous, more practical end of the EV spectrum. The Chevrolet Bolt, the Nissan Leaf, the base models of the Hyundai Ioniq. These vehicles provide all the benefits of electric driving, without the massive price tag and insane performance of their luxury counterparts. Because their initial cost is lower, the threshold for them being totaled after an accident is much higher. Their owners also fit a profile that insurers love. They tend to be eco-conscious, plan their trips carefully to manage range, and are generally not the type of drivers doing burnouts at traffic lights. They represent a low-risk, predictable slice of the EV market, and their premiums reflect that. Your choice of vehicle is one of the biggest single decisions that impacts your auto insurance rate, a decision you make long before you ever even shop for a quote. It sets your baseline. Choosing a car from the golden list instead of the death list can by itself cut your potential premium by 30, 40, or even 50%. But here's the thing. Even if you're currently driving a car from that high-risk list, all hope is not lost. Your car is only one piece of a very large and complex puzzle. The next and arguably most powerful piece you can control is the vast hidden world of discounts. We're not just talking about the obvious ones. There are over 24 potential discounts that can be applied to your policy, and your insurance company has absolutely no obligation to tell you about all of them. In the next part, we are going to expose every single one. We'll show you how to find them, how to qualify for them, and most importantly, how to stack them one on top of the other, to systematically dismantle a high premium and rebuild it into something you can actually afford. Let's start with the foundation. These are the discounts you've probably heard of, but I guarantee you're not maximizing them. Think of them as the low-hanging fruit, but the sweetest ones are always at the top of the branch. First up, the multi-policy or bundling discount. This is the king of all discounts. Insurers are desperate to get more of your business because a customer with 2 policies is 5 times less likely to leave than a customer with 1. It's not about loyalty, it's about hassle. It's a pain to move your auto insurance, but it's a nightmare to move your auto, home, and umbrella policies all at once. They know this, so they offer you a massive discount, sometimes up to 25%, just to create that inertia. The pro move here isn't just to ask, do you offer a bundling discount? It's to ask, what is the maximum possible discount for bundling auto with home, renters, life, and even pet insurance? Squeeze every drop out of it. And if you're a renter, don't you dare think this doesn't apply to you. Renter's insurance can cost as little as $15 a month, but bundling it can save you $20 a month on your car insurance. You are literally getting paid to have your stuff protected. Next, the good student discount. If you or a driver on your policy is in high school or a full-time college student with a B average or better, this is a non-negotiable discount. But here's the inside track. Most people let this discount fall off the moment they graduate. Big mistake. Many insurers have a recent graduate or young professional discount that can extend those savings for another 1 to 2 years after you've thrown your cap in the air. You have to ask for it specifically. It doesn't just happen. Also, for parents with a student away at college without a car, more than 100 miles from home, that's another huge one. The student away at school discount. The insurer knows the risk of them driving is practically zero, so your premium for them should be too. And the third of the big 3, the safe driver discount. This isn't just about not having accidents. This has evolved. Today, it's about proving you're a safe driver through telematics. This is the little plug-in device or smartphone app that tracks your driving habits. Now I know what you're thinking. I don't want my insurance company spying on me. And that's a valid concern. But let's be brutally honest. Your phone, your car, your smart speaker, they're already tracking you. The question is, are you getting paid for it? With telematics, you are. We're talking potential savings of up to 30 or even 40% for elite drivers. The secret is the trial period. Most major companies offer a trial run. You can use the app for 90 days, see what your discount would be, and if you don't like it, you can opt out with no penalty. The best practice? Don't brake hard. Don't accelerate like you're at a drag race. And for the love of all that is holy, put your phone down. Late night driving is also a major red flag for them. So those 2 a.m. taco runs can cost you. Master those things for 90 days, lock in a massive discount, and then enjoy the savings for years. Now let's move into the next tier. The discounts you should be getting but probably aren't checking for. These are often tied to your car and your personal status. Let's talk about your vehicle's safety features. Anti-lock brakes, airbags, daytime running lights, and anti-theft system. These can all chip away at your premium. Most modern cars have these, and the discount should be applied automatically based on your VIN number. But should is the key word. You need to be your own auditor. Pull up your policy declaration page. Look at the line item discounts. If you have a factory-installed alarm and you don't see an anti-theft device discount, you need to make a phone call. That's your money. Same goes for a new car discount, which often applies to cars less than 3 years old. Then there's you, the driver. Are you a member of, well, anything? This is the secret world of affinity discounts. Insurers partner with thousands of organizations to offer special rates to their members. We're talking alumni associations, professional organizations like the American Medical Association or the National Education Association, credit unions, wholesale clubs like Costco, even certain employers. If you work for a large company or the government, there's a good chance you qualify for a group rate. Go to your HR portal or your alumni association's website and search for member benefits. You might find a private, discounted portal to an insurer that you never knew existed. This is free money you're leaving on the table just by not knowing who you're associated with. And what about your driving habits? Beyond telematics, there's the low mileage discount. In the age of remote work, this has become the single most powerful and underutilized discount available. Insurers built their pricing models on the assumption that the average American drives 13,000 miles a year. If you're working from home and driving half that, you are half the risk. You should not be paying the same premium. You need to call your insurer and demand a re-rating based on your current, lower mileage. Don't estimate. Go look at your odometer. Give them a hard number. This one change can slash your bill by 15% or more overnight. Now for the truly deep cuts. The discounts almost no one asks about. Let's talk about how you pay. Are you paying your premium monthly? If so, you're likely paying a service fee of $3 to $5 every single time. It's a penalty for convenience. If you pay your 6-month premium in full, upfront, you not only avoid those fees but you often get an additional paid-in-full discount of 5 to 10%. Combine that with a paperless discount for getting your bills via email, and an EFT discount for setting up automatic payments from your bank account. Each one is small, maybe 2 or 3%. But this is where the magic of stacking comes in. 2% here, 5% there, 3% for that, it adds up to a real number. Here's one most agents won't even volunteer. The homeowner discount. Notice I didn't say homeowner's insurance bundling discount. This is different. Some companies will give you a discount on your auto insurance simply for being a homeowner, even if your home is insured with a completely different company. Why? Because their data shows that homeowners are statistically more stable and less risky than renters. It signals responsibility. You have to ask for it by name. Do you offer a non-bundled homeowner discount? The silence on the other end of the phone will be your answer. So, how do we put this all together? How do we stack these from a list of possibilities into a rock-solid savings strategy? Let's invent a driver. We'll call her Sarah. Sarah's 32, she's a registered nurse, she rents an apartment, and she drives a 2023 Honda Civic about 8,000 miles a year. Her initial quote is a painful $1,800 for a 6-month premium. $300 a month. Ouch. Here's what Sarah does. First, she gets a renter's insurance policy for $15 a month and bundles it. Boom! A 10% multi-policy discount. Savings. $180. Second, she remembers she's a member of the American Nurses Association. She checks their website, finds a partner link for her insurer, and gets a 5% affinity discount. Savings. $90. Third, She calls her agent and updates her annual mileage from the default 12,000 to her actual 8,000. That's a low mileage discount. Another 8% off. Savings. $144. Fourth, she agrees to go paperless and pay her premium in full via EFT. That's a stack of a 2% discount and a 5% discount. Plus she avoids $30 in monthly service fees. Total savings. About $156. Fifth, she realizes her nursing degree is from a major university. She calls back and asks about an alumni discount. Turns out they have one. Another 5% off. Savings. $90. Finally, she spent one Saturday taking an online defensive driving course approved by her state. It cost her $25, but it gives her a 10% discount for 3 years straight. Savings in the first 6 months alone. $180. Let's add it up. Sarah stacks 6 different discounts. Her initial $1,800 premium has been slashed by a staggering $840. Her new 6-month premium is $960. She just cut her car insurance bill by 47%, saving her over $1,600 a year. She didn't change her car. She didn't change her coverage. She just became an expert architect of her own policy. This is not a fantasy. This is a repeatable process. Every discount is a tool, a lever. Your job is to find every single lever you are entitled to and pull them all at once. You have to be relentless. You have to be your own advocate, because no one is going to volunteer to save you this much money. Now you have the list. You have the blueprint. You know which discounts exist and how they can be combined to create massive savings. But knowing what to ask for is only half the battle. The other half is how you ask. It's about the conversation you have with the insurance agent or the retention specialist. There are specific phrases, specific questions, and a specific tone you need to use to unlock their maximum flexibility and get them to not only apply these discounts, but to dig for others you don't even know about. And that is exactly what we are going to break down next. I'm going to give you the word-for-word scripts, the exact playbook for that all-important phone call. Alright, grab a notepad, because this is the moment where knowledge turns into real hard cash back in your pocket. This isn't just about making a phone call. It's about conducting a strategic financial operation. Think of yourself not as a customer begging for a discount, but as a valued client conducting a periodic account review. The person on the other end of the line? They're not your adversary. They are a gatekeeper with a set of keys. Our job is to politely and systematically ask them to try every single key on the lock. First, let's set the stage. The pre-call checklist. Do not pick up the phone until you have these 3 things in front of you. Number 1. Your current policy's declarations page. This is your map. It shows your current coverages, your deductibles, and, most importantly, your current premium. You need to know exactly what you're paying for right now. Number 2. Your list of potential discounts. This is the list you've been building throughout this guide. Your car's VIN number to look up safety features, your estimated annual mileage, the names of any professional organizations or alumni groups you belong to, your good student's GPA, everything. This is your ammunition. Number 3, and this is the ace up your sleeve. At least 1, preferably 2, competitive quotes from other insurance companies for the exact same coverage. You get these online, it takes 10 minutes. This isn't for threatening to leave. It's for leverage. It's the ultimate reality check that anchors the entire conversation. Got it? Declarations page, discount list, competitive quotes. Now let's dial the number. The moment they answer, the game begins. Your tone is everything. You need to be friendly, patient, and cheerful. Remember, you're a long-lost friend they just haven't met yet. Honey, not vinegar. Here is your opening script. Word for word. Hi, my name is, your name, and my policy number is, your policy number. I'm not calling with any problems at all, everything's been great. I'm just calling to do a quick policy review. I want to make sure I'm still getting the best possible rate, and that I'm taking advantage of all the discounts I'm eligible for. Do you have a few minutes to help me with that? Let's break down why this is pure gold. You've immediately set a positive, non-confrontational tone. You've stated your goal clearly, and you've asked for their help, empowering them and making them a collaborator, not an opponent. 9 times out of 10, they will happily agree. Now we move into the discount gauntlet. You are going to systematically go through your list. Don't dump it all on them at once. Guide them. Let's start with the easy ones. Great, thank you so much. First, I wanted to double-check my vehicle information. I have a year, make, model. Can you confirm that I'm getting all the available discounts for its safety and anti-theft features? For example, I know it has anti-lock brakes, daytime running lights, and a factory-installed alarm system. You're not asking if you get a discount. You're assuming the discounts exist and asking them to confirm you're getting them. It's a subtle but powerful psychological shift. Next, you move to your driving habits. Okay, perfect. Now, regarding my driving record, I know I have the good driver discount, but I also wanted to check on my mileage. I'm driving a lot less these days, probably only about your estimated annual miles per year. Can we check if I qualify for a low mileage discount, or if there's a better rate tier based on that? Again, you're providing new specific information that gives them a reason to look deeper and make a change. Now let's talk about you as a person. Your affiliations. Also, since my last review, I've become a member of AAA-AARP, a specific union and alumni association, etc. I've heard you sometimes offer discounts for affiliations like that. Could you check if any of mine qualify? This is where you pull out that list you made. Even if they only find one, that could be another 5 to 10%. It all adds up. After you've gone through your specific list items, good student, defensive driving course, paperless billing, pay in full, any of the discounts we've discussed, it's time for the single most important question you will ask on this call. I call this the magic question. Are you ready? Memorize this. I really appreciate you checking all of those for me. I have one last question. Based on my profile, what are the top 3 discounts that your highest saving customers have that I don't currently have? I'm just curious if there's some big opportunity I'm completely missing. This question is a game changer. You've just turned the tables. You're no longer asking them to check boxes. You are asking for their expert advice. You're challenging them to use their internal system knowledge to find you money. They know the system inside and out. They know about the obscure bundle no one asks for or the new pilot program for telematics. This question unlocks that knowledge. It makes them your personal savings consultant. Let them think for a minute. The silence might be where you find the biggest savings of all. Now let's say they found you some savings. Fantastic. But we're not done yet. It's time to play our ace. It's time to introduce the competitive quotes. You do this politely and strategically. Here's the script. This is all really helpful, thank you. You've been able to bring the 6-month premium down to the new total they gave you. I do want to be transparent with you because my goal is really to stay with your insurance company. I've been happy with the service, but I did get a quote from competitor's name for the exact same coverage, and they came in at competitor's lower price. Is there any other adjustment you can make or any other discount you can find to help close that gap? I'd much rather give my business to you. Boom! That is the knockout punch delivered in a velvet glove. You've complimented them. You've stated your desire to stay loyal. You've given them a concrete, real-world number to compete with. And you've framed it as them helping you stay with them. This often triggers a different level of authority. They might suddenly say, well, let me put you on a brief hold. There is one other thing I can check. That's when they go to a supervisor or look for a special rate matching or customer retention discount that is not on the public menu. Now, 2 things can happen. Either they come back with a better offer or they don't. If they come back with a number you're happy with, it's time to lock it in. That's fantastic. Thank you so much, you've been incredibly helpful. So just to confirm, my new 6-month premium will be the final new price. And that will take effect on my next billing cycle? Great. Could you also please email me an updated declarations page reflecting these changes, so I have it for my records? Always get it in writing. Always confirm the details. But what if they say no? What if they say, I'm sorry, that's the absolute best I can do. Do you give up? No. You have one final play. The polite escalation. I completely understand and I really appreciate you trying. Before I make my final decision, would it be possible to speak with a customer retention specialist? I've been a customer for X years and I'd really like to find a way to make this work, and I know sometimes they have access to different options. Would that be possible? This is your last-ditch effort, and it's incredibly effective. You're not angry. You're not demanding. You're calmly and politely asking to speak to the department whose entire job is to keep you from leaving. Often, that specialist has the authority to apply a one-time discount or a special credit that the first-level agent simply does not. This entire playbook, from the pre-call checklist to the final escalation, is your blueprint for cutting your rate by 10, 20, even 40% or more in a single 30-minute phone call. It's about being prepared, being polite, and being persistent. But saving money isn't a one-time event. It's an ongoing strategy. Your rate can and will creep back up over time if you're not vigilant. That's called the loyalty tax, and it's one of the biggest traps in the insurance world. So how do you avoid it? How do you make these savings permanent and build a system that keeps your rates low year after year, almost on autopilot? That is the final crucial piece of the puzzle. It's called the automatic savings system, and it's not about finding a magic bullet discount. It's about changing your relationship with your insurance company forever. Instead of being a passive customer who just accepts a renewal notice, you become the active manager of your own policy. You take control. This system has 4 core pillars, and once you set them up, they practically run themselves. Pillar 1 is the most important. The insurance freedom date. Pull out your phone right now. Go to your calendar. Find the date your current auto insurance policy expires. Now count back 45 days. Create a recurring annual event on that date. Label it "Cut My Car Insurance Bill." Why 45 days? It's the strategic sweet spot. It's far enough out that you're not scrambling at the last minute, which is when you make mistakes and accept bad deals. But it's close enough that the quotes you get will be accurate and valid for your renewal period. 30 days is okay, but 45 gives you breathing room. It puts you in the driver's seat, not the insurance company. This single calendar event is your rebellion against the loyalty tax. It's the alarm bell that wakes you up before they quietly pick your pocket for another year. This isn't just a reminder. It's an appointment with your money. An appointment you will never miss again. Pillar 2. The 60-minute money machine. This is what you do on your insurance freedom date. You are going to dedicate 1 single hour to shopping for insurance. That's it. 1 hour once a year. Think about the return on investment. If you save $500, you just paid yourself $500 for an hour of work. Find me another job that pays that well. Before you start, create a go bag of information. Have a digital note or a piece of paper with your current policy's declaration page, your vehicle identification numbers, the driver's license numbers for everyone on your policy, and the dates of any tickets or accidents in the last 5 years. Having this ready means you don't waste a second. Now you execute a 3-pronged attack. First, spend 20 minutes on an online insurance comparison site. The big ones. You know their names. This casts a wide net and gives you a baseline of the market rate. Don't buy anything here. You're just gathering intelligence. Second, spend the next 20 minutes going directly to the websites of 2 or 3 major carriers that maybe didn't show up in the comparison, like Geico or Progressive. Get direct quotes. Sometimes they reserve their best rates for their own websites. Third, and this is the step most people skip, spend the final 20 minutes calling a local independent insurance agent. These agents can access quotes from smaller, regional companies that you've never even heard of. Companies that might have the absolute best rate for your specific situation. In 1 hour, you've surveyed the entire market from every angle. You now know with near certainty what a fair price for your coverage is. You're armed with data. This leads to Pillar 3, the retention ransom call. Your current insurance company is banking on you being too lazy to leave. They spend a fortune acquiring new customers, so keeping an existing one, even at a lower price, is a huge win for them. So you call them. You don't call to cancel. You call to negotiate. The script is simple. You say, "Hi, my policy is up for renewal, and my new premium is set to be," mention the high renewal price. "I've done some shopping and I have a quote from competitor's name. For the exact same coverage for," mention your lowest quote. "I've been a happy customer and I'd really prefer to stay with you. Is there any way you can match that price?" Then you stop talking. The silence is your power. Let the retention specialist do their job. They will go searching for discounts you didn't even know existed. A special retention credit, a persistency discount. The names change, but the result is the same. Your bill goes down. Sometimes they'll match it perfectly. Sometimes they'll get close. And sometimes they won't budge. If they don't budge, you now have zero guilt about leaving. You gave them a chance. You thank them for their time and you switch to the new carrier you found. You've replaced loyalty that costs you money with strategy that makes you money. And finally, Pillar 4, the digital shield. The one downside to shopping around is the flood of emails and phone calls. You can solve this permanently. Create a brand new free email address. Something like johnsmithinsurancequotes@email.com. Use this email for all your quoting activities. For the phone number, use a free Google Voice number. It forwards to your real phone, but you can set it to Do Not Disturb and screen calls. This way, your personal phone and email remain pristine. Your insurance shopping life is contained in a neat, separate box that you only open once a year. It keeps you sane and in control of the communication. So let's put it all together. You've built a system. A recurring date in your calendar triggers a 1-hour, high-impact research session. You use that research to force your current company to give you their best price, or you walk away emotion-free to a better deal. And you do it all from behind a digital shield that protects your privacy. This is how you win. This is how you turn a mandatory expense into a source of savings, year after year after year. Over these 10 parts, we've dismantled every piece of the auto insurance puzzle. We've looked past the funny commercials and the catchy jingles to see the raw numbers underneath. We've learned that your credit score can matter more than your driving record. We've seen how tiny tweaks to your deductibles can unlock hundreds in savings. We've exposed the myth of loyalty and replaced it with the power of information. The ultimate secret to saving money on car insurance in 2026 and beyond isn't a secret at all. It's a mindset shift. You are not just a driver. You are the chief financial officer of your life. And this is one of your line items. It deserves a moment of your strategic attention. The money you save isn't just a number on a screen. That's a weekend trip you couldn't afford. That's a dent in your credit card debt. That's a boost to your investment account. It's real freedom, purchased with 1 hour of your time. You now have the complete playbook. The question is, will you use it? Set that calendar alert. Build your system. Take back your money. You've earned it.